Welcome back, everyone. Patrick here. Moving on to the next question in the financial statement algebra section. We got this example here. Now, this example is written out in the lecture notes. You don't have to write this out. You can print those out. They're at the beginning of the section on the website. So a new business during its first year had revenues of $400,000, expenses of $270,000, plus dividends of $11,000 that were paid. In addition, at the start of the year, the two owners contributed $80,000 each to the business. What is the equity and retained earnings at the end of the first year? So first thing I'm going to do with this question, as I mentioned in the overview at the beginning of the section, is draw out the flow diagram that we went over in the overview. So we're going to have a beginning balance sheet, which is assets equals liabilities plus equity, and then that's going to be broken down into capital, retained earnings. The equity is broken down into that. And then we're going to have a change in assets. And that's going to equal a change in liabilities plus a change in equity. This is going to be the changes to the balance sheet during the period or during the year in this question. That's going to be a change in capital. And then that's going to be a change in retained earnings. And then finally, we'll end up with the ending balance sheet assets equals liabilities plus equity. And then that equity is going to be retained earnings, ending retained earnings, and capital, like that. And then this change in retained earnings is a separate calculation. I'll put it over here. It's equal to the net income minus the dividends. Then the net income is broken down into revenue minus expenses. And so from here, what we can do is just fill in what we're given. So notice it says a new business. So whenever I see a new business, automatically I assume the balance sheet at the beginning of the period over here, everything is zero. So the assets were zero, the liabilities were zero, the equity was zero. Now, if the equity was zero, it means the capital was zero, and the retained earnings account was zero as well. So a new business, no balance sheet at the beginning, and then what it says is during its first year, it had revenues of $400,000, expenses of $270,000, plus dividends of $11,000 that were paid. So that information, where does it go in the flow diagram? It goes over here. So we have revenues of $400,000, that's over here, expenses of $270,000, and then we have dividends of $11,000, which is over here. And then it says, in addition, at the start of the year, the two owners contributed $80,000 each to the business. Now, personally, when I see this, basically that's a change in capital. So when it says at the start of the year, I'm assuming that it's still during the year. And a contribution made by the owners to the business, we know that that is owner's capital. So that's a change in capital. There's two owners, $80,000 each. So we know the change in capital is going to be $160,000 over here. Now, if the question gave us information about the starting capital at the beginning, then there would be a number here, and then a further contribution within the year, then that number would go here, then there would be two numbers over here. But because it was a new business, I just assumed this was zero, and then that contribution made by the owners, I put as a change in capital over here. And then that's all the information we're given, and what they're asking for is what is the equity and retained earnings at the end of the first year. So at the end of the period, what they're asking for is this equity. Let's actually just circle it. And they're asking for the ending retained earnings. So that's what we're trying to get to with all of this information that we're given. So notice that we're really not going to be working with the assets and liabilities. We're not given beginning assets. We're not giving a change in assets or a change in liabilities. We're not given ending assets or ending liabilities. So this portion we're not going to be using. We're pretty much going to be just using this portion over here. And notice that because we have the beginning capital and then the change in capital, we know the beginning capital plus the change in capital gives us our ending capital, which would be right there. And we need that in order to get this ending equity, because if we have the ending capital and we have the ending retained earnings, then the sum of those is going to give us our ending equity. The question is, how do we get this ending retained earnings? Well, notice we're given the beginning retained earnings, which is 0. The change in retained earnings we're not given, but notice that we can figure out over here. We have enough information to figure it out. So notice we're given revenues and expenses, 400,000 minus 270,000, that gives us 130,000 for the net income. And they may ask, this question could have easily asked, what is the net income? Or what is the profit? What is the earnings? You may see different words being used for net income. And that would be the answer, 130,000. They didn't ask for it in this question, but they can ask for it. And then notice that we have the net income and we have the dividends. So net income minus dividends gives us 119,000, which is the change in retained earnings. And then this number can flow over here. The beginning retained earnings was 0. The change in retained earnings is 119,000. So that would give us our ending retained earnings, right? 0 plus this gives us that. And notice that that's actually one of the answers to the question, the 119,000. So that's the ending retained earnings. That's one of the answers. And then they also ask for the ending equity, which is this. And because we have the ending capital and the ending retained earnings, we can just add those. And that would give us what? 279,000? And so that ends up being the answer for that ending equity. So 119,000 for the ending retained earnings and then 279,000 for the ending equity.